What's up, everyone? It's Scotty with MoneyVest. So let's talk about SolarEdge, which is selling off a little bit aggressively today. So definitely down over another 10 to 12%. And looks like the pain just does not end. And Enphase, of course, down over 4 to 5%. And so selling off on SolarEdge on earnings. And the brutality of the guidance is quite significant, and that's exactly what I want to touch on in this video and give you a little bit more insight into what the solar sector is going to look like over the next 12 months. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining. The first week of the month is the best time to join, and you also do get access to our spreadsheets, intrinsic value spreadsheets, our volatility cheat sheets, and there's going to be a ton of more benefits coming on very, very soon, including our MoneyVest Pro platform that you can get early access to very, very soon. So link's going to be down below, and again, we'll love to have you on board. So let's talk about the first thing, which is going to be the actual numbers. Let me just pull that up here 1 second. I thought I had it up there. Okay, there we go. There's the numbers. Okay, just 1 second while I figure this out. There we go. Okay, perfect. So this right here, SolarEdge shares sink after company offers weak fourth quarter guidance. And I also want to touch on the competition, right? Because Enphase is also going through a very similar, process of cutting their guidance significantly on the back of, weakening demand, on the back of significant pressure from higher interest rates. The solar sector is struggling amid weakened demand weighed down by high interest rates. So the financing cost is definitely super high for solar panels, microinverters, solar systems. So that's why the demand is starting to roll over. And we're seeing significant cuts in guidance from these companies. So they tanked 22% out of the company, swings to a surprise loss as well. So not only did they cut their guidance, but they actually reported a surprise loss per share in this earnings call, right? So in this earnings report. So basically, if you come over to SEDG, you'll notice that the earnings per share actually came in at negative 55 cents per share versus estimates of 82 cents per share, with the revenue coming in at just over 725 million, and estimate was 770 million. So miss on both revenue and EPS for the company, and it's down a little bit over 17% at the moment. So yes, definitely pretty significant. So that's the numbers we already went over. And for the current quarter, the solar producer said it expects revenue between $300 and $350 million, missing analyst expectations of $688 million. That's a pretty wide miss, right? It's over a 50% miss. On the low end of the guidance, it's over 50% lower than what the analysts were expecting. And the SolarEdge CEO said on Wednesday in a statement that the third quarter disappointment is a reflection of the slow market environment, which has resulted in higher inventories of our products in the distribution channels. Now, when they talk about distribution channels, I mean, these companies don't necessarily sell directly to customers, right? Enphase, Solar, and of course, SolarEdge and First Run and whatnot. They sell to other distributing channels, which then sell to customers. So their demand from distribution channels is definitely seeing a lot of weakness, right? And what I mean by that is because of higher interest rates, customers are not buying solar systems, solar panels, and microinverters, which is why distribution centers and channels are not buying it from these companies such as Enphase and First Solar and SolarEdge. And that's a big problem, right? It's a chain of events which is happening because of higher interest rates, which is also creating this buildup in inventory because they're producing all these panels and they're producing all these microinverters, which nobody at the moment is buying. And so inventory levels are elevated while interest rates are also higher. So it's a very, very, challenging time for the solar sector. So this is straight from the earnings call. And I specifically wanted to highlight, so they mentioned that we have not seen a significant change in market dynamics since our second quarter call, and the market is still being adversely impacted by higher interest rates and uncertainties around the pace of adoption of NIM 3.0 systems in California. So almost identical stuff to what Enphase, CEO Budry also mentioned. They mentioned that they're being impacted in the slowdown in overall demand because of higher interest rates. Now, these were the numbers. GAAP revenues coming in at $725 million, revenue from solar segment $676 million, GAAP gross margins at 19.7%. So this actually was one of the things that really bad for SolarEdge, but kind of restores confidence in Enphase a little bit. And that because Enphase's margins did not go down. If anything, Enphase's margins actually went higher Although when you take the Inflation Reduction Act, IRA contributions out of it, then of course they're sitting at closer to 40% on the low end and closer to 45-46% on the higher end. So what I'm really focusing on for Enphase moving forward is, are the margins, can the margins really hold up on the back of the moat that the company has? Because they do have a lot of technical advantage over companies like SolarEdge and First Solar, I would argue, even First Run. So a lot of these companies, they do offer a significant moat in terms of that technical capabilities of their microinverters. They're more efficient, they're more powerful. Battery storage may not be as comparable, but at the end of the day, they are far more, these are microinverters that are seeked out more by consumers than by SolarEdge or First Solar. So that alone should be able to protect the margins, right? Because that's also one thing that Badri mentioned, is that their main goal, its main focus is going to be selling higher premium priced microinverters so that their margins continue to stay steady. And they did, right? They did stay steady. In fact, they increased on a year-over-year basis in the last earnings call they just reported. But of course, companies like SolarEdge are struggling, coming down to now under 20% in non-GAAP gross margins. And then we did have non-GAAP operating income of $23 million and operating income from solar segment, $45 million, but of course a GAAP net loss of $61.2 million and also a non-GAAP net loss of $31 million. So swinging to the downside, swinging back to losses here, although it does still have a very strong balance sheet with $831 million more cash and investments than compared to debt. So they do have a negative net debt position still at the moment. So these are the margins that I wanted to highlight. So significant reduction from 32% to 19.7%. Because look, in this industry, in this sector, it is very, very important for companies to protect their moat, because if it's not a moat, then it gets commoditized to a point where anyone can enter your market and start producing solar panels and microinverters. It's really not that complicated. So technological advancements are very, very important in this type of industry, and like almost every industry, but in this one more specifically because it can be commoditized very easily because it's a high growth business, right? It's a solar revolution over the next 10 years is going to be pretty significant, as we know, with a lot of countries, a lot of governments subsidizing in that direction and offering a lot of benefits or incentives to the consumers to install solar panels, and businesses even to install solar panels and start using renewable energy. So holding off the competition and conserving your margins is very, very important. And SolarEdge, significant drop on a non-GAAP basis from 32.7% to 20.8%. That's probably one of the reasons why we did see a significant swing back to negative numbers here. So GAAP net income, net loss, and non-GAAP basis also net loss of $31 million for the company. Now, like I said, the balance sheet's still pretty strong. If you're looking at $1.5 billion worth of cash and investments, with total debt sitting at $633 million. So that part is good, but I also want to focus on the inventory levels. So this right here, if you take a look at inventories where they were third quarter of last year, $561 million. Take a look at where we are now, 1.2 billion, right? That's over 100% increase on a year-over-year basis for inventory levels. So it's clear the demand is not there. It's starting to not see that level of sell-through rates among distribution channels. And as a result, we are seeing margins compress, earnings go down for companies like SolarEdge. Enphase is still, in my opinion, in a much better position. So that kind of helps us understand that, okay, Enphase has a little bit of a significant moat, competitive advantage compared to some of the other companies, because margins were still pretty strong, balance sheets obviously better. And inventory levels, last time I checked, I think was increasing because of the backlog. And that's something that they also mentioned in the earnings call. But I'm not sure exactly how much it increased on a year-over-year basis. That's something that maybe we can look at later. But fourth quarter guidance, and this is where majority of the damage is happening. And the funny thing is that they already mentioned this in October when they said that, our expectations are significantly lower now, and we're not going to be able to beat expectations. And the stock dropped, took down the entire solar sector. And when they actually reported those numbers, it took down even further, right? So non-GAAP gross margins expected to be within range of 5 to 8%, including approximately 130 basis points of net IRA manufacturing tax credit. So that's the Inflation Reduction Act. And non-GAAP operating expenses to be within range of $126 to $130 million in revenue from the solar segment, or 275 to 320. Gross margin from solar segment expected to be within range of 7 to 10%, including approximately 130 basis points of net IRA manufacturing tax credit. Revenues between 300 and 350 million. That was obviously the big reason why the stock is selling off. Now, if you take a look at the company's fundamentals, right, it has actually done really well, but they've always operated with lower lower margins compared to Enphase. So if I come over to, the last few years, they're looking at, 3 to 4%, sometimes 8 to 9% net profit margin. Whereas if you compare this to Enphase, they've operated at well over, 17, 18% margins, right? So some years, of course, 2021, we did see margin compression down to 10.5%, but their margins have been closer to 20% as opposed to 10% with SolarEdge. Now, if you come back over to SEDG, down 17.6, but like I said, the company's numbers have been pretty solid in the past, but the market doesn't care about what's happened in the past. It cares about what's upcoming in the next few quarters in the future. Valuations depressed, right, for a lot of companies. I mean, SolarEdge, Enphase even trading at ridiculously low valuations. For SolarEdge specifically, we're looking at under 11 times forward earnings multiple, with a price to sales at a little bit over 1.16, and price to cash flow at 8.75 as well, with margins, of course, compressing down at the moment. Now, there's no way for me to actually calculate what the intrinsic value is going to be for this company, because it looks like they are going to be generating negative earnings this year, or at least over the next couple of quarters, because analyst expectations are going to really change for the company. So you can see that this right here was negative, and I won't be surprised if fourth quarter 23 is also negative. There's no doubt about it. I mean, they already cut their guidance by 50%, so these need to be readjusted at the moment. So bottom line is, what the solar market, right? So if you take a look at TAN, which is a solar Invesco ETF, it's just been on a straight decline here, down over 45% in the last few months. So what it's actually going through right now is a significant amount of pressure because of higher interest rates. Now, long term, as we know, 5 years, if you look out 7 years and look out 10 years out, 2030 and beyond, this industry still has significant potential for growth. But all it comes down to is which companies can weather the uncertainty and the challenges that we're facing today, right? For example, can SolarEdge survive this downturn of weakening demand and higher interest rates long enough until when the market rebounds? Or will they have to eventually file for bankruptcy and go out of business before the market turns, before the economy with respect to interest rates and the demand turns? That's the real question. And in the short term, I can tell you that this company has no problems with balance sheet wise, because as we already know, they've got a lot more cash than total debt. And I believe they might even have a lot more cash compared to their overall liabilities. So their total liabilities are sitting at 2.1 billion, and cash right now is sitting at about 1.4. So we're not that far off, right? These companies are very well capitalized in terms of the cash versus debt. Even for Enphase, they've got more debt than cash on the balance sheet. So in the short term, again, about almost $500 million more cash than debt on the balance sheet, and total liabilities are 2.5 billion, with total cash sitting at just about 1.7 billion, right? So again, more cash than debt, more cash than liabilities on the balance sheet. So these are well-capitalized companies for now. Can they continue to survive this way if this goes on for a few more quarters of weakening demand, and we don't see a lot of recovery in the solar space? Time will tell. But as long as margins are holding up, for Enphase specifically, right? Margins need to be above 40% in my opinion, excluding IRA, and including IRA, it needs to be over 50%. As long as margins hold up, and as long as the company is showing some growth on a year-over-year basis, then I think the thesis still holds true, and the positive free cash flows keep coming in. But if we start to see the debt levels increase over cash, margins compress, free cash flows and profitability also turning negative like we did with SolarEdge, that would not be good. Then the question would really be, how long is this going to go on for, and can they survive this downturn and then come out stronger in the process of when we do see that recovery? Because the comps are going to be very good, right? I mean, if you compare these numbers to next year, right? So for example, fourth quarter 24, when Enphase is reporting, SolarEdge is reporting, they're going to be comparing against these numbers, and that can show Wall Street growth of about 100-200% on a year-over-year basis. That is only if interest rates actually are going to be lower. So that's the big question. So bottom line is, Enphase, in my opinion, is still a higher quality business. That's just my opinion, of course. Make sure you do your due diligence and research on that. And over the long term, I do think that they're well capitalized for now. We'll find out eventually, and this is more of a macro thesis. That's very much macro-driven play, because higher interest rates are hurting this sector left and right at the moment. So a lot of companies are dropping like flies because of cutting their guidance in this particular sector. So let me know your thoughts down in the comment section below. As always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below if you're interested in joining. As always, happy investing. I'll see you all in the next video.